do we have a Ponzi market?
Yes.
I'm not saying the entire market is false, but over time there has been an increasing percentage of value that's really phantom value, or we call it Ponzi value, that at some point will need to be cleansed from the system. You just said yes earlier, so
Yeah. To me, it's not even a question. And again, remember the characteristics of where the capital is coming from to reward investors. It used to come through cash flow to investors in the form of dividends or other forms of distributions. Today, it's almost all capital gains, right? And capital gains can certainly make sense if the fortunes of the underlying business are improving and justifying it. But we're seeing very crazy outcomes where the largest companies are carrying multiples that imply the law of large numbers no longer operate.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. There's a mechanical force that pushes asset prices higher as capital flows passively into the market each and every month. As more money flows in, it must be used to purchase assets at whatever current price they're trading at. That valuation-insensitive purchasing results in higher and higher prices. Today's guest refers to this current system as the giant mindless robot, and in his view, it's deformed our financial markets into a gargantuan Ponzi scheme of unprecedented scale. One that someday must go bust, as all Ponzis do. For the details on this, we'll spend the next hour with Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management. Mike, thanks so much for joining us today.
Adam, it's good to be back.
Hey, thanks, Mike. All right, well, look, let's just roll up our sleeves and jump into the thick of it here. Last time you were on this program, the many times you and I have talked in the past, we've talked a lot about the dynamic that you call the giant mindless robot, which are these vast passive capital flows that go in and theoretically out of markets at different times. The switch has been flipped to in for quite a long time. You have said that you have concerns that we could get to a situation where that flip switches to out, and kind of the world that investors have become very used to, where with few exceptions, the markets just kind of keep inexorably going higher and higher and higher over time, that whole process could literally become undone, go into reverse, and all of a sudden we're in this upside down world that investors just don't have the musculature to deal with. When we talked last back in January, you had said, hey, I'm beginning to see some concerning signs that maybe we're getting a little bit closer than I'd like to, or feel comfortable about getting to that stage. I want to ask you, okay, so where are we now? Maybe let me ask you two questions if I can be unfair. Let's kick off your answer with my general question of what's your current assessment of the global economy and financial markets? But once you've delivered that, kind of bring it to what's happening with capital flows right now.
Yeah, so to hit on the current assessment of global markets, we are in the late stages of an expansion or moving into a recession broadly in the United States. There's many indicators that we actually are in recession that will see that revised. Now, the problem, of course, is that is completely at odds with what we're seeing in financial markets. And that's part of the reason why I spend so much time arguing or discussing the dynamics of passive, because I think it's very important to understand that those two can separate in a very meaningful way. But we are seeing unemployment rise in the United States. We're now seeing unemployment claims reflect some of that. Part of that has actually been a point that I've argued over and over again, which is that the benefits associated with claims are so low that instead of seeking unemployment, people simply find opportunities in the gig economy, something like driving for Uber, for example. Mm-hmm. Now, that's actually a positive in a lot of ways, right? It means that you don't have the burden associated with pro-cyclical government or contra-cyclical government spending that could further inflame dynamics like the deficit. But the flip side of that equation is those jobs actually have a unique feature to them. The more people that try to drive for Uber, the less profitable driving for Uber becomes. And you end up actually creating a pro-cyclical framework that means when people finally do hit the unemployment lines, the system has deteriorated to the point that there really are no options left, and they're left with significantly deteriorated circumstances. Anna Wong, who is the chief economist at Bloomberg, has done work on this that echoes the work that I've done, basically highlighting that we've set unemployment compensation at such low levels that the only people that come in and apply for unemployment are those who rely on public transportation for their job, right? So if you have a car that you're driving to work, you can theoretically work for Uber and earn significantly greater than unemployment compensation while continuing to depreciate the asset that you have in place. For those who don't, and I think we saw this most notably in California with the passage of the minimum wage laws tied to fast food workers, many of whom are actually below that threshold, you actually started to see the unemployment claims spike and rise. But I don't think that we're going to get a really strong unemployment signal in this cycle in the same way, for the very simple reason that we've had such low rates of labor force growth and we need to replace the baby boomers. Right? If we do see a surge in unemployment, it's going to be tied to things like productivity breakthroughs that significantly disrupt the system, even while they're creating long-term opportunity. The second component is that we've seen the flows, which are traditionally tied to the level of unemployment and gains in 401k participation. We have seen those start to slow and in some cases reverse themselves. Passive continues to take inflows on net. I can share a chart very quickly, which is the one that captured the concern that I had. So let me actually just show this to your listeners here very quickly. So this is looking at the Vanguard Total Market Index, which is kind of that broadest, most broadly utilized tool for 401k allocations. It's the core equity allocation asset in many target date funds. You can actually see how this has basically slowed and been flat since March 2023. Now, part of what appears to be happening is a rotation out of broad indices and into more narrow indices, which has its own interesting characteristics. If everybody suddenly decides they get the joke and they decide to rotate from the S&P 500 or a total market index to the S&P 500 growth, for example, or a technology fund because they want to participate in AI, they make that allocation choice. That could manifest itself in exactly what we've seen up until very recently, which is a narrowing of the market, outperformance by those names, even as things like the Russell 2000 remain significantly below its 2021 highs. Again, you can see the behavior in today's small cap market where we're up somewhere in the neighborhood of 9% in just the past 4 days of some catch-up components associated with rotation, whether that's tied to short covering or whether that's tied to new money. It's really unclear. It's just far too early to actually know in that process. But all of that notwithstanding, we've seen unemployment rise. We're starting to see it rise significantly for those with college degrees. There was a significant jump in this last period. We're also seeing it begin to rise for those that are operating in less skilled sectors. And this is as home building, which is kind of the true cyclical component associated with the less skilled worker, begins to deteriorate fairly significantly. Builder confidence is down. Inventory for new homes is near the record levels. And the opportunities are apparently disappearing. Terms of unemployment are rising, et cetera. So we're in this really weird place where people who follow the economy, I think, are broadly looking at it and saying, one, we have a bifurcated economy where if you're very wealthy, you're benefiting from income off of your assets that you weren't getting before. If you're less wealthy, you're seeing pressure on your consumption side through inflation forces and through reduced employment prospects. And that's creating some of the social tension and stress that we're experiencing. But on that high-end customer, even there, we're now starting to see warning signs, right? Burberry and Hugo Boss, et cetera, have announced that things are not looking so rosy. Nike, which is somewhat of an aspirational brand, but also has characteristics along those lines showing weakness.
Swatch, which owns a bunch of luxury watch brands as well.
Right.
Terrible.
Luxury watch brands are in the absolute toilet. It's hard to know how much of that is tied to changing technology in watches and fashion trends as compared to the watches themselves, but clearly there is a missing crypto bid associated with high-end watches. So you are seeing some weakening on that, and then the housing market, of course, is the one that has really been suspiciously strong just on a lack of inventory. And I will tell you that the anecdotal experience and the empirical data that I'm beginning to see suggests more time on inventory Price cuts are increasingly becoming the norm. And that supply is ultimately going to be tied very much to the employment cycle as well. If you lose your job and you've tapped every other asset, you can't refinance that home when you're unemployed. It suddenly turns into, well, I get the cash by selling, and that supply rises. And very much like I was discussing with Uber before, it becomes a pro-cyclical price phenomenon. So I think all of those things suggest that the economy is much weaker than the stock market behaves. And the flip side of that, of course, is many then turn around and point to the stock market as a supposedly all-knowing mechanism, saying, well, how can you explain stocks at all-time highs? And my answer to that is very simple. There's a passive bid associated with it.
All right, I've got so many questions, but let me hold on to that last one there, which is everything you basically just said sort of seems to suggest, okay, we got higher unemployment coming, maybe not crazy high, but higher than we have now. Economy's slowing. Even the it's been a K-shaped recovery since COVID, but even the short wealthy end of the K is now starting to have some issues to it. So when you talk about the stock market kind of still signaling nominally that all is well, if we continue on this trajectory of rising unemployment, slowing economy, more painful housing conditions, et cetera, do you expect some sort of corrective event in the markets at some point?
I mean, I do, but let's be very clear. I've been wrong about those expectations, right? So I have to approach it with a degree of humility to say, sure. I don't have full transparency on it. I don't know exactly why the markets are less responsive to the data that we're seeing. I do think that the core of it is an increase in passive share, and I think there's a combination of components there. So Vanguard just announced that they're seeing a higher and higher fraction of employees taking maximum deductions against their 401ks. The savings rates on that basis are significantly higher. So there's two separate components that play into how much money goes into the stock market. One is a function of how many people have jobs and are participating in 401ks or IRAs. And the second is a function of how much each individual is contributing. If that individual contribution goes up, that helps to ameliorate the concerns about withdrawals. And we are seeing evidence of that, right? So this has been one of the frustrating aspects of this is ever since I realized the underlying dynamics of the passive influence and how that was going to play out, we've actually seen greater and greater support for inflows, ranging from increasing benefits to corporations, for matching employee contributions, extending the withdrawal dates for 401ks, what are called the required minimum distribution dates, changing dynamics around inheritance of 401ks to limit the liquidation so that there's a quote unquote tax advantage associated with it. But it's a very weird tax advantage to actually be passing through if you think about it. My general sense is that the Vanguards and BlackRocks of the world are increasingly aware of these dynamics. It's very hard to conceal them when the academic community is increasingly supporting all of the work and research that I've done on this. And so I think you're fighting a battle where they're constantly expanding the opportunities for people to contribute at the same time that the inevitable dynamics around demographics and aging of baby boomers will lead to outflows. Right. So we know it's coming. It's just a question of when does it actually arrive?
Okay. All right. So great. A lot of things to talk about there. So one, what you're saying, which we see an awful lot in both government, but also in the corporate world, right, is when the going gets tough, the guys in charge change the rules, right, in their favor, right? So you're saying, okay, maybe they're aware of the robot risk going into reverse that you've been ringing the bell on. And so they're getting out there and just trying to do whatever they can to kind of keep the spice flowing, right? We're going to make it easier and easier for people to keep putting money into their retirement accounts here. So not shocked to hear about that. But it's interesting because you mentioned sort of two things. Certainly something that could impair these flows, right, is enough of a recession where enough people get laid off that they're not able to they don't have incomes anymore, they don't have salaries anymore to put away, right? and we can talk maybe in a minute about your outlook on unemployment, because you mentioned Anna Wong. I actually had her on the program last week,
I
and she
listened, yeah.
mentioned, oh, thanks. And you mentioned that she mentioned that she has the highest unemployment prediction for the end of the year of any in her peer set, and right now that's at 4.5%. And I'd love to talk with you a little bit more about that too, because she said, hey, like a traditional recession would see unemployment go even higher, 5%, 6%, et cetera. But she said by the time we're at 4.5%, it's going to feel like a recession for a lot of people, right? So anyways, we have a recession risk that could, impair the robot in the near term. And then if we wait long enough, a decade and a half, we're going to get to the point where it's not 10,000 people boomers hitting retirement age every day. It's going to be 10,000 boomers going to the nursing home or dying, right? And that's going to, as you said, really heavily push the switch to outflow for the robot. Is there anything in the in between? Are there any other factors that could impair the capital flows as well?
Yeah, I think there's a combination of factors. So one is, and some of them work against it, right? So, if you think about the dynamics around, and I overuse the word dynamics as YouTube commenters point out, but if you think about the mechanical properties of contributions versus withdrawals, contributions are always going to be a function of income levels, right? So if there are more workers making more money, they can contribute more assets. On the flip side, withdrawals are almost always going to at least have an element of the asset level in them, right? This is the case particularly for pension plans or nonprofit endowments, but also for things like 401ks and IRAs, where they have required minimum distribution levels. Those rise with your age. The dollar value of those withdrawals rise with your asset levels.
Right.
And so
Ergo, meaning
valuations,
more assets have to be sold as you age.
more dollar value. Yes. So there's two dimensions, right? In terms of 401ks and IRAs, it is more assets need to be sold. By the time you get to 90 years old, you have to liquidate something like 20% of your portfolio every year. You start out at like 4, right? And so as we move forward in time, we're going to see those distributions rise simply as a function of the baby boomers aging into those higher distribution levels. The second is that it's a function of the asset level as well. So if I'm pulling out 4% of my assets and those assets are $1 million, I have to take $40,000 in distributions, which can only be obtained by selling securities.
Mm-hmm.
That 40,000 is significantly greater than the 16,700 or 19,000, I think it is currently actually, that you can contribute to a 401k. Right. So when you start actually shifting the system in that direction, and if that portfolio doubles to $2 million, then you're taking out 80,000, et cetera. So those mechanical components ultimately mean the system has to go into distribution at some point. But predicting when is a function primarily of figuring out where those contributions could slow or at minimum stop growing on an individual basis. And secondly, where we're going to actually see those distributions materialize. There is some pretty strong evidence that the net 401k flows at this point are actually negative. But because of the distributional characteristics of what people own, they're selling active managers. And on net, they're buying passive managers. So we're seeing outflows from active managers, inflows into passive managers. And this is where another component of passive starts to play through, which is effectively the multiplier component. So if I estimate the market impact of a active manager receiving an inflow and choosing to deploy that capital, its impact on the market cap of the market is somewhere in the neighborhood of $2 impact for every dollar that you actually receive. The reason why there's a multiplier there is you have to convince somebody else to sell to you. Mm-hmm. Right. So you have to bid up that price to a certain extent. As many people do that, it pushes the price higher. Active discretionary managers have a natural price sensitivity to them, and they have a capacity to hold cash so that they don't have to put that money to work. A lot of the academic research that's now being done is around the inelasticity of index funds, meaning every dollar that you put in has to be put to work in the securities that represent the benchmark or index that you're investing in. And my math suggests, and again, another piece of academic research just came out in the past couple of weeks that further supports this point. My evidence is that the multiplier for that passive manager is currently north of like 17, right? So that dollar coming out of the active manager subtracts $2. That dollar going into the passive manager adds $17. And so we're seeing that positive net contribution. The other component is when you think about the share of assets that are held by passive versus active, it really only recently kind of crossed over to that 50th percentile. And that's not a homogeneous distribution. So the older generations own more active managers, so they're selling that 2 times multiplier. And the younger generations are investing into passive managers, so they're receiving that 17 times multiplier, right? That's actually benefiting the boomers on their way out in a significant degree. I think those are the dynamics that are causing us to kind of end up with the market behavior that we're seeing, where flows can appear to be relatively flat, but that's hiding a lot of activity under the surface, much like a duck on a pond.
Yeah. Okay. So here's the high level question that I just want to ask here, which is, is this good? Right? Like just at a very high level, is this wise? Is this a wise way to run a market? Right? In other words, it's kind of like having an auction house where you've got a buyer in there who kind of has an infinite wallet, and so he has to go in there and just buy what he wants at top dollar, where you're saying the active manager, has the ability to say, you know what, this thing's getting too rich. I'm sitting this one out, right? I can sit in cash, whatever, right? Where these passive buyers are like, this money's coming in. I got to buy these stocks, and therefore I got to allocate this stuff, and therefore your stocks are rising. And what I think some could argue, they could be rising for unnatural reasons, or they're finding an unnatural price. It's not true price discovery. And so does it build up a system to the point where it is very vulnerable to, through one way or another, price discovery having to re-enter, and people that are used to a 17 times multiplier are all of a sudden, repriced at a 2 times one?
So I think that's absolutely the case. We've seen that in a number of areas. Things like SaaS investment, for example, has seen its multiple fall significantly. And that's complicating things down the chain, right? So it's not simply a function of prices going higher. It's actually the implications of investment. So when the largest companies are actually benefiting most from these types of flows, and there's, again, a mechanical reason why that's actually occurring. It's because volume and volatility are what determine liquidity. It is not the market capitalization. So Microsoft at $3 trillion in market capitalization versus Delta Airlines at roughly $30 billion in market capitalization. When Vanguard goes to buy in proportion to market cap, they're buying, 10 times, 10 times, no, 100 times, I'm sorry, as much Microsoft as they are Delta Airlines. And the liquidity in Microsoft is only about 5 to 10 times higher than that of Delta Airlines. There are reasons why that occurs, the primary one being the properties of market making. If you are going to market make in a stock, you have to put a quantity of capital up against it. The profitability of that capital is determined by the spread between the bid ask and the quantity of shares traded. Nowhere in that did I mention market capitalization. So you don't scale your market making operations to manage Microsoft. You scale them to manage, companies relative to their market representation in terms of volume of shares that are traded and the bid ask associated with that. That's one of the reasons why you see such enthusiasm for things like a GameStop, et cetera, because the bid asks get so wide, it becomes hugely profitable for them to participate. I assure you, nobody at GameStop is really sticking it to the man over at Citadel Securities, right? That misunderstanding is actually helping to explain a lot of the phenomenon that we see in the United States, including the rise of superstar firms like Microsoft. Because if Microsoft's share price is pushed up more than smaller competitors by the passive bid, it actually causes Microsoft to compensate its employees much more effectively with share-based compensation as compared to cash-based
Right.
compensation.
And sorry to
That
interrupt, but it can also acquire, smaller competitors with that richer equity and therefore
100%.
protect itself more. Yeah.
Right. And that's exactly what we've seen. And so the failure to enforce antitrust rules have led to situations where Google has acquired 1,500 companies in the past 3 years, right? These are astonishing rates of acquisition that are supported by these share prices. It is a form of malinvestment that we don't think of that way because we see share prices going higher, and we continue to apply the traditional models, things like the Grossman-Stiglitz paradox, which presumes that the information content in share prices is actually what's driving them higher. It's not. It's the mechanical properties of a system that is, designed effectively to push the largest stocks higher.
And so I don't know if you know the answer to this, but Microsoft, I'm sure, loves this, right? The big firms love it, on Wall Street love it. So the folks that are making a lot of money off of it love it. And those, I think, in large part, are the folks that are kind of running the current power structure, right? So, so what kind of limiter is there on this, right?
There's not really, and that's actually one of the key reasons it becomes so caustic to society. So the work of David Autor at MIT is hugely important in this, right? The primary driver of the rise in inequality in the United States has been a function of the rise in superstar firms. If you have a neighbor who happens to work for Microsoft and you happen to work for Intel, his fortunes are going to be far greater than your fortunes. Is it because of your unique contribution to society and your unique capabilities? No, you won the recruitment lottery, right? The example was being.
Sorry to interrupt, but my wife has a somewhat extended family member who worked for Microsoft, retired a while ago, but had a fair amount of Microsoft shares from their time at the company, and retired early in life, like 50 or younger, and is far wealthier today than when they made the decision to retire early, because Microsoft has just been on this nonstop tear ever since.
Yeah, I mean, that's a very good example of it. I think one that was floating around the internet the other day was if you'd taken a marketing job at NVIDIA paying $70,000 for the standard stock compensation package, in the past 2 years, you've now become worth $10 million, right? Was there something you uniquely did in that process? Of course not, right? Do you somehow deserve that? Well, you have to tell yourself you do, or you're going to be an incredibly unhappy individual. And so we have these weird narratives that are emerge around, the dynamics of effectively when you're rich, they think you really know, right? We have a meritocratic system. That person rose and pulled themselves up by their bootstraps. That's just not true. And because so many people actually understand this on a visceral level, even if they don't understand the mechanical properties that are leading to these types of inequalities, it's creating tremendous friction in our society.
Okay, so last time we talked, you and I spent a bit of time talking about that friction. It's quite near and dear to my heart. Talk about it a lot with the other experts on this channel. I'd actually love to kind of get your latest thoughts on that, but I think we still have some more wood to chop here. Yep. All right, so let's go to all right. Well, actually, on this point here. So at some point, if it goes on long enough, whether it's the demographics that you mentioned with the boomers starting to retire at big enough volume where the robot flips into outflow mode, and then this whole house of cards starts, falling apart the way that it's been getting built up over the past bunch of years. I mean, I guess we could have some sort of populist revolt that changes regulatory policy around this, or changes the game. I don't know. Is that realistic before the boomers hit that retirement level in 10 or 15 years? Do people get fed up enough that, hey, I've mentioned the stat a lot that 93% of the financial assets are owned by the top 10% of households. And this game that you're talking about is just making those households richer at a faster rate, the longer this game goes on. At some point, will there be enough social blowback that somebody reevaluates what's going on here and saying like, look, this is just not fair. It's creating an aristocracy, maybe even an oligarchy. We gotta, we gotta, you know, we gotta do something that's a bit more populist.
Um, I'm always cautious of the use of the phrase populist because of the, French Revolution characteristics associated with it. And so I'm not suggesting that the answer is armed rebellion or an overthrow of the government or anything along those lines.
Yeah,
Nor
nor am I. I
candid,
was just saying enough
right,
concern that they make changes. They
right.
start to end the game for the fat cats that are loving it right now.
Well, so unfortunately, that tends to be what occurs around revolutions. People think about peasant revolutions, but that's not really the organizing principle. It's typically elites competing with other elites. And so I'll take an extreme version and just point to Donald Trump, for example. If you think that Donald Trump is going to relish having people richer than him push back and tell him how he should behave, I would be very surprised that that's the case, right? We hear all the time about the ideas of debt jubilees, right? Well, remember what a debt is. It's actually your liability and somebody else's asset. And so when you talk about a debt jubilee, what you're actually doing is stripping a subset of the population of their assets. The reason you do that is political control. When a king is elevated, he announces a debt jubilee to weaken his opposition, not to strengthen the underlying economy. So you're actually, making a system more authoritarian, even as it pleases the populace. What it's really doing is it's weakening the elites.
Got
And
it.
so this is going to happen one way or
Totally agree.
another.
But just because this debt jubilee comes up, it could also be sort of a be careful what you wish for, right? Which is like, hey, you know what? You don't have a mortgage anymore. We've wiped it away. Congratulations. By the way, your pension's gone because your pension held all these loans.
Yeah, no, those are the unintended consequences as people think about it, right? So if you happen to be, rich in student loan debt or in mortgage debt, there's a very real risk. Now, in the case of government-sponsored mortgages, we actually have a fund at Simplify associated with those. I'd point out that your liability is not tied to the mortgage, it's a government-issued liability, right? Same is true for student debt. The government ultimately is still going to pay those debts off. They just have given up the tax revenue associated with it that we call the repayment of student loans. All sorts of terrible special interest and quote unquote populist type behavior is occurring there, as basically people are buying votes that gives them access to to being the head of the most powerful corporation in the world, the US government. So this is a frustrating period in which a principled evaluation of most of the proposals and most of the behaviors that we're undergoing leads to people shouting, this is unsustainable. And in many ways it is. I don't think it's necessarily for the reasons that people think it is, but that's somewhat unrelated to the overall point.
Okay. But sorry, I think just back to my question. Do you see there being, sort of a political drive to fix this system that we're talking about here, this passive flow system that we're talking about here, before we get to the easily calculable demographic ending of it, if enough time is allowed to play out?
Well, again, remember, it's not easily calculable because it is a conditional system, right? So you could change the rules around withdrawals and simply say, okay, now that your money's in a 401k, you never need to take it out. For a subset of the population, that'd be a wonderful gift. For the vast majority of people, they need those assets in order to fund their retirement. And so again, that'd just be a huge giveaway to the rich. But the vast majority of people looking at their 401k would say, wait, you mean you'll make 401ks permanently tax-free? Oh, that benefits me. That sounds like a good idea, right? And so, the principled component to it is ultimately what falls. I heard this actually on a Twitter Spaces the other day. I don't care about anything else. I'm just in it for my pocketbook. I'm going to vote with my pocketbook. And that sounds really responsible, but that's actually exactly the reason that we have representative government, because we're trying to remove a degree of democracy. We're trying to remove the rule of the mob and the true special interest of self, and actually say, let's adopt a principled approach that is theoretically better for us as a society in the direction that we want to go. And we just seem to have lost that capacity.
I completely agree, and that's a whole other discussion. But I guess one other, so you're kind of giving a variation of the, hey, look, they'll change the rules a lot of times on here, and so it's
Yep.
hard to predict anything with any degree of certainty because we don't know what those rule changes
What?
are going to be.
Yeah.
And one big one here could be immigration. I mean, I can understand the argument for massive, large-scale immigration into this country. If we want, I've heard the demographers make it from a, hey, if we want our economy, our current economic model to continue to work, we need more people than we're currently producing in this country. So I get that. But if they just brought in a flood of them, yeah, when a boomer retires and starts taking distributions, that's in large, if they're being actively managed, that's selling a 2x multiplier asset. But if we've got a bunch of new people who are putting 17 multiplier assets into the system, well, that can keep the game going for a lot longer.
Absolutely could keep it going. And I think that's actually been a contributor to the process. While many people focus on the illegal immigration and the benefits that are being handed out in places like New York City, I mean, a thoughtful guy I know, said, well, most of the immigrants are staying in hotels. And I'm like, no, they're not. What are you talking about? When you're talking about 3 to 4 million people coming in, they don't stay in hotels, right? They may pack 10 into a single bedroom apartment, but they're not staying in hotels. And so there's just again, a misplaced narrative around a lot of that stuff. I agree with you in terms of the general observation that is a solution set that solves for the stock market, but doesn't necessarily solve for the needs of the individual in the United States. And again, we're seeing people react to that. The second phenomenon that occurs, and this is less of an issue for the United States with a very large population base, but cumulative immigration, particularly of the illegal form, phrase this, the structure of society where people feel that the society and the societal myths that they partake in and that they grew up with and the character of that society, you can call it latent racism, you can call it whatever you want, but there's absolutely a component when you talk about that representative democracy and saying, where do you want to go? You want your voice as an existing citizen to matter more than the new voices that come in. And again, this was part of the dynamic of the breakdown of the Roman Republic. A massive influx of Carthaginian slaves created conditions under which the local worker became impoverished and basically put onto the equivalent of Social Security at that, or Medicare and Medicaid at that point, right? I'm blanking on the term for it, but the annual allotment of grain that you received as a Roman citizen became effectively the source of income for many individuals, and then they participated in various black market components. We're seeing elements of that in our society.
Okay, and that is that is something I've wanted to talk more about on this channel, but I don't think, given the time we have left, this is the right opportunity to get into it. Okay, so let me now just try to summarize what I've taken from what you've said so far, and correct me if I'm wrong. And then once we kind of get this clarified, then I want to get more sort of short term. But what I hear you saying about your general thesis of the passive capital flows that are overinflating asset prices to levels that at some point there will be some reckoning resulting from. I hear you saying, we're definitely passing some key milestones. Like, I think if I heard you correctly, you said that net 401k flows are negative at this point. But given the other dynamics that are going on, the game is still continuing for now. You're not ringing a warning bell that you're saying, hey, I'm seeing some sort of imminent reversal of the status quo here. Sounds like you're saying, I'm just watching it closely. This is extremely multifactorial. And there's some longer term threats I've got my eye clearly on, but in the immediate term, while I'm not feeling great about things, I'm not telling people, hey, the passive game is ending anytime demonstrably soon. So you're not telling people to assume the crash position.
Yeah, I wish that I hate this aspect of it, right? Because I'm trying to raise the alarm and try to warn people The biggest risk that we always have is when we're speculating and we think we're behaving responsibly, right? So people look for bubble-like behavior. They'll point to crypto tokens, or they'll point to GameStop, or they'll point to all of these things that to me are actually very minor relative to the much bigger story that's going on, which is the incredible flow of assets into passive vehicles, where, to quote other market commentators, people presume that they're saving in the S&P 500, right? It's not a savings account. It's a risk asset. It has uncertain return potential associated with it. And for people as they get older, that's a really inappropriate allocation to be 70, 80, 90, or 100% in equities. We just see too much of that at this point, and it's perfectly understandable because we've seen buy the dip work so well, et cetera. Those narratives that you hear, that it's all the Fed, that it's, dollar debasement, et cetera, that's causing this price action, they're just not accurate. What is happening in the market is we're seeing a mechanical bid that is inflating securities prices and reinforcing momentum characteristics. It is the byproduct of the policies that we've chosen as a society and is effectively a series of market custodians. It can't sustain itself. The returns that we're experiencing are abnormal, but weirdly could become even more exponential if passive share gain continues in an unabated fashion. It will end in tears. There is no other way around that, right? And so I'll give just a really simple summary. I have a brand new paper. I actually just put this out on Twitter. A brand new paper came out from one of my colleagues who's at Harvard Business School, is professor at Harvard, who's doing a lot of the academic work around my theories. And we were discussing the dynamics of his new paper called "Who Clears the Market When Passive Investors Trade?" This is part of a growing body of academic research that looks at the exact mechanical properties of what I was referring to. And we were discussing the dynamic in his paper, and I observed that the firm behavior, so the sum total of his analysis, is that when passive investors buy, that the primary seller is actually the companies themselves, not through share issuance, but actually through compensating their employees with employee stock ownership programs, right? Or option grants. And if you look at the payout structure associated with that, I'm going to try to pull this up on the screen so your audience can actually see this. Share my screen one more time.
And as you're doing that, Mike, in your answer, can you address, once you make the main point, can you address what impact, if any, that corporate stock buybacks then have on the same dynamic?
Yeah. So yes, right. But so this is looking here at index fund demand on the x-axis. This is shares out, change in shares outstanding. As it goes up, this is an increase in index share demand, right? This is companies' demand, so firm demand. You'll notice that as index demand goes up, the companies issue more shares.
Mm-hmm.
Okay. Look what happens when index share goes down. Does company demand increase? No. Right. So the convex nature of this actually is a payout function that looks exactly like a call option, because that's exactly what it is. These are employee shares being bought through share option grants. Right. Now, the reason this becomes a big deal is if passive starts selling, and the companies who have been the ones providing the shares to meet the objectives of the passive buyers are not on the other side of the trade, who is? Right? And I will read you the direct quote from Marco. In the case of a passive sell-off, we don't really know who the natural buyer is. Kind of scary to think about if suddenly people decide to pull money out of Vanguard, BlackRock, State Street.
All right. So this is to my auction analogy. This is, getting used to participating in an auction where when one guy raises his paddle, he's going to keep raising it until he buys. You show up at the auction one day, he's not there. All of a sudden it's, okay, so where's the next marginal buyer?
Exactly.
Is he a dollar right behind where that guy was? Or is he 60% less, right?
And likewise, there's that sinking feeling. We've all kind of had it where we got emotionally caught up in the auction and we validate our decision to participate because other people are participating. And you put your paddle up and you pay a little bit more than you think you were supposed to, but you're caught up in the moment and no other paddle comes up. And all of a sudden you're saying, oh my gosh, I have to explain to my wife what I just did.
Yeah.
Right. That unfortunately is what it's going to feel like.
So, all right. So again, this is the risk that we've been talking about here of this reckoning that will happen at some point. Very quickly on the data that you just showed, you basically, what I took from that is, hey, as long as the market's willing to buy, companies are willing to sell shares to them, right? I mean, it's just incentive,
by way
right?
of employee compensation, right? So
Yep.
you are playing a role in making Tim Cook extraordinarily wealthy.
Yeah. But also employees benefit because shareholders of all stripes benefit from company buybacks. And if you're fortunate enough to be one of these magic companies where you have a good business model that generates a lot of cash, like these big magnificent tech companies do, but also you have this wonderful currency of this ever rising stock price that you can use to do a lot of other things that you might otherwise need to spend cash on. You can turn around and buy a lot of shares and increase the optically the earnings per share, and that drives the market likes that and drives prices higher as well. So I assume that call option structure that you mentioned there, and the benefits to employees who own, who get rewarded with equity, that only gets magnified by this corporate share buyback dynamic. Is that true?
Yes, absolutely. And again, remember, a significant fraction of the cash that's used to repurchase shares is actually coming from the issuance of those shares themselves. So if I issue a call option at 110 and my stock is currently at 100, it goes to 120. The employee has to exercise that call option. That means that they sell the shares for 120, pocket $10 for themselves, and pay the company 110. Right. So a huge source of cash flow that's coming into many of these large companies is actually coming from that share issuance.
Yeah, it's super interesting. So it does kind of create this virtuous cycle to
Well,
some
it's a
point.
virtuous cycle, but it's also a Ponzi cycle, right?
Right.
And it has important ramifications for other businesses that don't happen to be part of these select few. They can't possibly compete in terms of hiring employees. Their business models don't allow them to raise prices because they've got cash enhanced competitors that are receiving the cash flow associated with this stealth issuance that allows them to compete without a hit to profit margins. Right. So this ripples through our society in a very profound way that I would argue we haven't even begun to consider.
All right, Mike, I think maybe you've just really crystallized it in my brain here, which is, do we have a Ponzi market? I'm not
Yes.
saying the entire market is false, but over time there has been an increasing percentage of value that's really phantom value, or we call it Ponzi value, that at some point will need to be cleansed from the system. You just said yes earlier, so
To me, it's not even a question. And again, remember the characteristics of where the capital is coming from to reward investors. It used to come through cash flow to investors in the form of dividends or other forms of distributions. Today, it's almost all capital gains, right? And capital gains can certainly make sense if the fortunes of the underlying business are improving and justifying it. But we're seeing very crazy outcomes where the largest companies are carrying multiples that imply the law of large numbers no longer operate.
Mm-hmm. So here's the issue, right? Who benefits from capital gains, right? Those who own the assets, right? Who are able to sell out and capture those. So Ponzi, the actual, scam artist that created the Ponzi scheme is named after. He went to prison and died penniless, right? The judicial system kind of caught him and made it pay for it, right? This time around, I don't know. I mean, it seems like we have I hate to use the term like this, but the elites, the wealthy that own the vast majority of these assets, they're benefiting the most from this, but they're able, through taking capital gains, to take real assets out of this system, so that by the time it implodes, highly unlikely that they're going to put all the people that in that cohort that benefited from it in jail. We're just going to probably look around and say, yeah, it sucks. I guess we weren't running the system very well. Sorry, everybody, for what happened. But at the end of the day, you end up with a small amount of people who own a lot of real assets. And then you have the vast majority that have just been, collectively taken the pain of the Ponzi breakdown of the market.
Well, unfortunately, that's the way it always works, right? So let's pretend we're a third world country for a second. What is the defining feature of places like Brazil or Venezuela or others? It's that those who are truly members of the elite actually have access to liquid capital that they can get offshore. They can get it out of the clutches of the authorities. In the United States, you're increasingly seeing elements of that, where people move assets in the form of corporate assets, et cetera, off to low tax havens, et cetera. The US runs the risk of creating those types of conditions in which people ultimately end up fleeing with their assets or selling their assets to get them offshore, or borrowing from the banking system to get assets offshore where they're theoretically untouchable. I've heard other guests talking about the dynamics of a currency collapse. The only way that really happens is effectively those individuals say, we are not going to repay our debts, right? It doesn't work in the other way. But in the meantime, the vast majority of individual people don't have that escape valve. The unique thing, and you've heard me talk about this before, the unique role that America played over the last 300 years was creating that escape valve where the working class could look at the elites in their country and give them the middle finger and say, I'm going to America. The problem is there's nowhere left to go. You're now in America. Where is the budding land of opportunity that can absorb 150 million immigrants from the United States who would be interested in protecting themselves? It doesn't exist, right? It was a unique period in history in which we found 2 new continents, emptied them by virtue of disease, and then brought over all the impoverished, our tired, huddled masses yearning to be free. Mm-hmm. It just doesn't exist anymore. And so, as a working class individual, and most of your listeners by definition are actually not going to be truly working class. They're going to be aspirationally affluent or better, right? But the simple reality is they don't have many options. And so they seek out things like Bitcoin or gold under the illusion that these are going to protect them from the collapse of society around them. It just doesn't work that way. This is a much more sobering message than the idea that the currency is going to collapse. We're actually talking about very fundamental changes to expectations and lives unless we get our act together very quickly.
Wow. Okay. So the day we're talking here, I just had a video with John Rubino launched this morning, and it, people would say, "Hey, it was pretty bearish." Basically, the video was saying, "Hey, maybe a near-term recession and bear market might be the least of our worries," and he's talking about a currency crisis that he thinks could happen over the next decade or more. You're kind of saying, "Hey, buddy, hold my beer. Currency crisis, that's what you're worried about? That may be the least of our worries."
Yeah, I think there's a very real chance that we have opened ourselves up to the end of democracy in the United States.
Okay. All right. I'm looking at the time and realizing, how do I go from a massive statement like that to anything that we can kind of use to put a bow on this discussion? You know what? I think it'd be great to have you back on at some point, Mike, and start with that.
No, your audience is like, get rid of this guy. I don't want to listen to this. This is terrible.
Well, yeah, for those who haven't put their heads too far into the oven quite yet, but it would be, I think, really fascinating to start the conversation with that declarative statement, right? And then do the old, okay, so if that's true, then so what? What about that? What should we be doing, the average people watching this show? And I do want to say it is somewhat ironic that the U.S. was the escape valve, and that's how you could get a better life, by leaving your heavy-handed country to come here. Now the moderate affluent person, I would say, the people who aren't ferociously wealthy, are now looking to these second and third world countries to say, well, that's where I'm going to go retire, right? It's like the pendulum's almost swinging back, which is that, well, at least I can hopefully make what I've been able to save up last me enough in an environment like that to be able to have some quality of life for my final act of life. All right, but let's get to the so what for the average person watching this right now. The end of democracy. I'm going to assume for a moment you don't think that that's going to happen tomorrow. That is
No.
somewhat of an out there. It's maybe a trajectory we can't get off of, but it's going to take a long while. As we look to, let's say, the rest of this year heading into next year. You mentioned a number of issues at the beginning, rising unemployment. We talked about Anna Wong's 4.5 unemployment prediction by the end of this year. You talked about the housing market starting to weaken. You talked about economic growth slowing, things like that, thinking that we may go into a recession. How, because you are focused on helping people position their assets in the here and now, how are you looking at the near-term roadmap and then translating that into a portfolio strategy?
Well, there's a couple of things that I think are actually really critical. One, instead of a currency crisis, as most people formulate it, my expectation is that the currency crisis will take its form and people can't gain access to the currency. And so I'm actually much more focused on assets that offer me a defined and predictable and guaranteed return of the capital that I put forward at this point. Things like short-term government bonds are an asset that I think will do fine. I'm not particularly worried about that. I'm more concerned about moving out the curve, but there's also a flip side of that equation, which is the underlying characteristics that you face during a period of very slow population growth. I'm just not worried about the dynamics of inflation in the traditional sense. I'm much more worried about the dynamics of deflationary conditions under which the assets that you currently own do not provide you with enough capital to pay off the debts that you have assumed. And that can include your living expenses going forward.
Meaning you're a big fan of income.
I'm a huge fan of income. I will tell you the most obvious trade that's out there at this point is to look at something like a longer dated tip and recognize that a 2+% real rate of interest in this type of environment is something that you should grab with both hands. Whether that ends up being the right call or not is very hard to know, but government bonds that are 50% off is not something, particularly if they're inflation protected, is not something I'm going to get particularly worried about yet. The other assets and the other components that people own, like I'm fully supportive of people continuing to ride this train because of the mechanical properties that I outlined. It is an exponential system. Just imagine that last dollar going into the last passive fund that exists. How much does it have to pay to buy a share of Microsoft when there's no other sellers? Right? The answer is a lot more than it's currently priced at. And so I fully understand the dynamics of wanting to ride that train, but I strongly encourage people to treat your portfolio as a barbell. Own some assets that will benefit in the event that there is actually something that looks like a debt deflation, where we recognize that many individuals are going to be unable to pay and service their debts, and corporations for that matter, because we've changed the rules yet again. The US government doesn't go bankrupt in dollar terms. It also can't solve the problem with money printing. And we know that. We actually do know that. So what we can do is we can raise taxes. We can actually engage in behavior that ultimately makes it far harder for people to retain control of their assets. I would point to things like the Biden administration introducing rent caps, right? Those are ways that you effectively devalue the real claim on assets because the government has put a tax on the system. Mm-hmm. These are all things that I expect we're going to see more and more of. And unfortunately, in those conditions, one of the assets you're going to be forced to buy under a financial repression type framework is government bonds. So you might as well consider buying some of them now.
Okay. All right. Interesting. So let me just make sure. So you're saying kind of barbell. On one side, it's T-bill and chill and having some longer duration government bonds, tips otherwise. On the other side, it's saying, look, we don't know how long this passive game's going to last for, or how crazy it may get till the end. Right. So have some exposure to that, right? That's sort of a potential asymmetric upside, right? do any other material asset classes in there? I know you mentioned gold and crypto earlier, but it sounds like you were a little dismissive of them.
No, I think ultimately the gold can play a role in a portfolio, as can crypto. You ultimately have to be very comfortable with the underlying asset and its viability, or other people's belief in it. My personal take on something like Bitcoin, unfortunately, is that if you actually play through the game of Bitcoin, it doesn't work, right? A truly rigid, quote unquote, money supply, which is really just a hoarded asset, can't actually maintain its security, et cetera. It needs to maintain a security budget associated with the blockchain. It's increasingly difficult for it to do so. Likewise, the assets that are actually invested in things like Bitcoin mining, the only utility they have, because they are focused on ASICs, is for Bitcoin mining, right? So if Bitcoin goes away, all of those assets basically go to zero. As a result, I bias towards gold, where effectively it is one of the few assets where there is no other liability associated with it. You just have to believe that people are going to continue to accept it or search for an alternative. And there's no way to, quote unquote, copy paste a element on the periodic table unless you happen to have control of a supernova. So I don't think many have that. So I'm not that worried about massive amounts of additional gold supply coming into the system.
Okay. And how about other sorts of forms of hard assets, say like real estate? You just mentioned there the government may put caps or find other ways to sort of tax the income that those real assets can generate. Is that something that keeps you away from them, or do you think they play a role?
So I think that tends to fall into the category of each individual should own what they need for themselves. And some people will obviously choose to pursue it in a professional capacity. But one of the more frightening things I've seen has been the general rise of, the pools of capital that are pursuing multifamily real estate, et cetera. Those types of investments ultimately are very, very risky. Not only do you have claims that are against you by other investors who are likely to resolve those in a court of law, which is extraordinarily expensive, but you also don't have the expertise in terms of the operations, the selection of assets, et cetera, in what is increasingly becoming an unfavored asset class, right? The ownership of rental properties, you fall into the classic landlord camp. Nobody loves you, right? So it just becomes one of those, why would you bother in this type of environment? Feels like an
Okay.
awful lot of risk.
All right. Super fascinating. I would so love to continue digging into this, but we're at the hour, and I know you have another
Yeah, I have a
engagement in
hard
just a
stop.
minute. Let me ask the most important question, which is, Michael, for folks that have really enjoyed this discussion, would like to follow you in your work, where should they go?
So if you want to follow the doom and gloom, which is not usually how I approach the world, but we are actually, I think, at an important inflection point on some of this stuff. You can read my work at yesigiveafig.com on Substack. You can also look for me on Twitter, where I am at profplum99. And then if you do have an interest in investing in vehicles that are designed to take traditional returns, modify them in one form or another, typically seeking additional protection in the form of hedges, Simplify is my employer. www.simplify.us is the best place to find out our offerings. We offer everything from high yield products with protection to managed futures that can gain exposure to the commodity cycles that you articulate, et cetera.
Um, Gosh, you're reminding me, one big topic I wanted to talk with you about was managed futures. I just had Andrew Beer on the channel not that long ago. Not sure how familiar you are with him, but he gave us a good kind of background into sort of the evolution of the hedge fund industry. And one of the things about it that he said, there's a lot of ways it sort of devolved over time, but there are elements that still have real value. One was managed futures. He's part of an organization, I think probably like you, trying to sort of bring that to the regular investor. We don't have time to go into it in depth, but is there anything you want to say about managed futures to this audience that still might be a relatively new topic for them?
Yeah, so we also offer a managed futures product in contrast to Andrew's product. Ours is a native CTA. So Andrew's product is designed to mimic an index. Ours is designed to express a particular point of view. I liken it to kind of old trends versus current trends. Um, our product, CTA is the ticker there, play on Commodity Trading Advisor, which is the traditional framework for managed futures structures, is managed by Charlie McGarrah of Altus Advisors, longtime friend of mine. He ran Goldman Sachs Metals Trading Desk, and he and his team at Altus have built just a fantastic trend following strategy. The simple answer is, if you actually are concerned about debasement, if you are concerned about trending characteristics like much higher inflation, and you're looking for allocations that effectively take my stupidity and flip it around and say, I'm going to be as stupid as the next guy and try to follow a trend. And I don't mean that in a disparaging way. I just want to be very clear. These things are often unknowable. Trend following is one of the strongest strategies. It effectively reinforces all the dynamics of momentum that we were referring to. The CTA product that we have, I am a huge fan of Charlie and the team, and the results certainly speak for themselves there.
Okay, great. When I edit this, Michael, I'll put up the links to your Substack, to your Twitter, to simplifyus.com, as well as the CTA ticker, so that interested folks can go research those at their leisure. I was going to conclude with my normal, what's a big lesson you've learned along your career, Mike, but we're going to have to save that to the next time you're on, because you got to go in a sec. All right. Well, look, folks, if you've enjoyed having Mike on this program and have really appreciated what he shared with us here, please let him know and encourage him to come back on as soon as the schedule allows by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And note, I think we're now probably like 1.5, 1.4 thousand subscribers away from our 100,000 subscriber goal milestone for this YouTube channel. So if you're watching and haven't subscribed yet, please do so now. It'll really help us out. Hitting 100,000 helps this channel burn more brightly with the YouTube algorithm. And look, Mike painted, I think a concerning picture, both in the relatively near term as well as in the longer term. And if you'd like to get some help in thinking through how to position for that type of future, highly recommend that you work under the guidance of a professional financial advisor who takes into account and understands all the issues that Mike just talked about here with us over the past hour. If you've got a good one who's already doing that and then translating that into a personal portfolio strategy for you and helping execute it for you, fantastic, stick with them. But if you don't, or you'd like a second opinion even from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple of seconds. These conversations, these consultations with these advisors are totally free. They'll just sit down with you. They'll hear your personal situation. They'll give you their best advice, and you can do with that whatever you will. There's no commitment to work with these guys. It's just a free public service that they offer. All right, Mike, I can't thank you enough. Really appreciate you coming on the channel. I'm going to forgo my typical, what's a big lesson you've learned over the course of your career, because we're out of time here. I want to be respectful that you need to get to your next obligation. But we'll pick it up there when you come on next time. Mike, thanks so much. Everybody else, thanks so much for watching.